Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, hi everyone, and welcome to Portfolio Construction. I understand that people are just checking that everything is working in the live streaming venue, which is the Hayden Allen Tank. So, hi everybody from the Hayden Allen Tank. I've never done live streaming before, so hopefully they can see and hear me, and in fact I think that's what I can see in the background, so yes they can. Alright, so while I just wait for any last minute people to come in, there's a couple of administrative things that I wanted to mention at the end, but I might actually quickly do it now. Some of you may have enrolled last week or the week before in a tutorial and then had that enrolment cancelled because everything had to be cleared in order to enable people to re-enroll. The reason is that the original tutorials had an issue in the way that they were set up. That was therefore cleared and timetabling had to run through it again. So hopefully you've all got an email from our administrator saying that you can enrol from 10 o'clock tomorrow. That's when they reopen. And the other thing I wanted to mention now before I forget is that if anyone hasn't yet changed their university password, please remember to do it by 31 July. If you're anything like me, you will have seen the little red box every time you log into Waddle telling you to do it and ignored it. I ignored it until about 3 days ago, when I finally remembered to update my password. If you don't do it, you won't be able to access any of the ANU services. Okay, so welcome again to Portfolio Construction. My name is Anna von Reignitz. You don't ever need to pronounce my last name. I can't pronounce my last name, my father tells me, so I don't expect any of you guys to get it right. Just Anna is fine. I've got to say, I'm really pleased to be back in this lecture theatre again, because before I start on the actual course content, I have to share this with you. The last time I was in this classroom was about 2 years ago. I was teaching portfolio construction. It was the worst time of lecture. I think it was 5 to 7 p.m. on a Wednesday, so, you know, by 5 o'clock I was really struggling to get ramped up for my first lecture. But checked the timetable, got here, set all of this up, so it said portfolio construction. The class was pretty full, so I was feeling pretty good, and I was about to launch into this, you know, hi everyone and welcome to Portfolio Construction, when someone in the front row came and obviously was trying to spare me embarrassment. So they walked up and just really quietly said, "This isn't Portfolio Construction, you're in the wrong room." Except of course I had a lapel mic, so the whole room heard what she was saying, and I was like, yes it is, I know I'm in the right room, I checked. So I got out my timetable, and it said Coombs, not Copeland. Have you guys ever been to Coombs? It's the other end of the university. So this is like now 5 past. I have heels on, running across the university. I pull up about 25 minutes past the hour in my first lecture, going, I'm so sorry guys, I got the room wrong, and then I got confused, and then I had to find Coombs, and I've never been into Coombs. And my class was just looking at me, and they were clearly thinking, all right, I think you're so lazy that you haven't bothered to turn up on time and you've come up with an excuse, Or you're so dim that you don't know how to read a timetable, which everyone else managed to do because we were all sitting here on time. And I don't know which of those is worse. So I'm really glad to be back here sort of getting rid of that bad PTSD experience of the wrong lecture theatre. And I think by definition I've started better this semester than I did back then. So always good to start on a high. Okay, so I think we're probably at the point. Yeah, let's get started. So obviously this course is portfolio construction. By this point you would have told me if I was in the wrong classroom again. And I've got to admit, I'm excited taking this because the last time I taught this course was first semester of last year, and I haven't had a big lecture course since. The other thing I do is a student managed fund, which you'll hear me reference all the time. I love it. It's one of my favourite things in the world. It's an undergraduate course where a small group of people, some of which I think might actually be here today, are managing real money, over $500,000 of real money. And it's incredible, but you know, we've now grown to 18 students, so it's a very different experience to what we have now. So it's been a long time since I've been in front of a class, and people like to criticise big lectures, basically because they say that it's really hard to take theory and bring it into reality. And I actually think that this class is one of those cases where that's absolutely not the case. It doesn't matter that there are sort of 400 or 500 of us. I haven't looked at the enrolment stats lately. Everything we do in this course is directly relevant to what's happening in industry and also to your everyday lives, right? Because think about it. You do corporate finance, you do investments, you do corporate valuation, which is another really practical course, and they're all geared towards a specific job in industry. And this one is too, right? You know, corporate valuation, you might be an equity research analyst. Here you might end up a fund manager. But the fact is, we're not all going to end up fund managers. We won't all end up equity research analysts. We won't all end up working on a company board. It would be lovely, but sadly, we won't all end up earning millions as a CEO. So each course is tied to a job that will be really relevant to what some of us end up doing. But the real focus in this course is how to create a portfolio of investments that's right for everybody, right for the individual person, with a particular focus on superannuation. So the reason I say this is applicable to every single person in this room is that no matter what job we end up doing, every one of us, I hope, will be accumulating money over the life at which they work and end up with a nice nest egg to fund their retirement. Right? So even if you don't use this in your career, I hope you'll take the lessons from this course and apply it to your superannuation. Because what we're going to see is that every single person in this room probably has a different portfolio that's right for them. How many people in this room are doing, something to do with engineering as part of their degrees? Do we have anyone? We got one? Science? Science is not popular nowadays, or? Accounting? There tends to be a lot of accountants. Okay, we got some accounting, good. What about combined with an arts degree? Or has a background in an arts degree? Yeah, we got arts. Okay, great. So can you see, we've all got slightly different backgrounds. We're learning different things. So we'll all end up in slightly different professions. Well, that's the first trigger to say different areas of work might have different exposures in their super fund. Because if you guys are fund managers in an active Australian equity fund in your job, and I told you that your superannuation fund should be 100% Australian equities, what would the problem be there? Risk, right? You've got your risk tied up in the job market, you've got risk in your super, and they're exactly the same. No diversification of risk there. If you are running a building company, you probably don't want your equity portfolio to be entirely comprised of building stocks, right? Well, what do you call that? Construction companies. Building stocks isn't really a word. Okay, so whatever your job is, that is going to start to affect your portfolio. Think about age. Let's say that you are in your late 20s, you're just starting to work. And let's say that your parents are in their early 60s, looking forward to being about to retire. And I say, all right, well, I'm going to give you guys, both you and your parents are going to have a superannuation portfolio with 10% fixed income, 90% equities. Which portfolio, would that be better suited to you guys or to your parents right now? you, right? What are your parents about to do? Retire. What does equities have? Risk, right? Right now, if you've still got decades in your working life, and I give you a portfolio with 90% equities, which, by the way, is a bit high, but it's an illustration, 90% equities, and the market crashes tomorrow. This is your super. Who cares? You guys have decades to ride it out. You're probably going to have 3 or 4 different market depressions before you end up retiring. And as long as the market recovers, you'd still be better off early on being in equities because the average growth rate of equities is higher. But if you are 1 year off retirement and you get another GFC take 2 and 90% of your portfolio is in equities, you are not going to be happy with your fund manager, right? Because your portfolio is going to crash. Your equities will crash with the market. You will not have enough time to see that portfolio recover. And you're going to think, why on earth was I not in safe, fixed income, some inflation-linked bonds, maybe a touch of commodities to hedge the inflation, a safe portfolio that isn't going to be obliterated temporarily by a market crash, right? So what we're going to learn is how to tailor portfolios to suit different clients as we go through. Okay, so in terms of what we're going to cover today, it's not a particularly technical lecture. We'll spend about half on what to expect from the course, the assessment, the assignment, exams, things like that. And we're going to spend the second half just giving an overview of the investment management industry. And essentially that's just going to provide a little bit of a roadmap for the weeks ahead. So I highly doubt anyone will leave today feeling like it was confusing or difficult. If you do, I've done a really bad job in teaching it to you because it's really just an overview of the type of things you're going to cover. But what that does mean is I'll probably throw out a lot of terms, some of which you may not have heard of before, but I'm really just flagging them for what we're going to cover in the weeks ahead. So I'll launch into some specific examples, but know that each one we're going to build on as we go through the course. Just to flag it from the front, in terms of what to expect from the course, as you've probably gathered so far from what I've said, it's very practitioner-oriented, right? This isn't a course where we spend a lot of time on the theory. We start with the theory, just enough to remind you of it, and then we tailor it to what works in reality. And to be honest, sometimes we sort of rip it apart and say it doesn't work. Here's what actually does. Because theories are so useful. You know, they give us a starting point, but they're a simplification. And as I'm going to talk about a bit later on, things like modern portfolio theory, if you try to apply that exactly in reality, you're going to end up using mean variance optimization to get some pretty weird portfolios and try to say that everyone should invest in them, which is just not the case. Now, given that it is practitioner-oriented, and you guys are going to be using real data and applying real industry methods and looking at real examples, you're going to do a lot of work in Excel. Now, I'm undergrads. I'm guessing have most of you done corporate valuation already? Yeah, I'm seeing some nods. Postgrads, I'm guessing you're doing this and applied valuation at the same time. So I think, and Joe's taking applied valuation this semester, is that right? Yeah. So I know that in applied valuation and in corporate, if you've done it, you've done heaps of Excel. It will be the same in this course. If you haven't yet done a lot of work with Excel, the best advice I can give you is open up those spreadsheets and just start playing around. Because Excel, it's not something that you can learn by watching someone else do it, right? You've got to get your hands dirty and start to experiment. And once you do, you'll find that you learn quite quickly, and it's really important, not just for this course, not just for corporate val, but for industry. Right? I went through academia, so I was really surprised when I spoke to most of my friends that are in industry, and I say, well, what programming language do they use? And they're like, what? I don't use a programming language. I use Excel. It's so much better. Because when you're in industry trying to look at models that you can communicate clearly to the client, where they can see the inputs and the outputs, Excel is the absolute standard, right? Something like SAS, like I use, it's fine when you're doing research on your own. But it's actually not as user-friendly when you're trying to communicate that to a client. So what you'll find is if you get good at Excel now, that's going to make your life really so much easier when you go into the workforce. And it's a big tick for your future employees as well. When they interview you and you can say that you can run all these different things, you can do a bootstrap in Excel, they're going to love it. So if you have any Excel questions, please do come and see me, go and see your tutors. There'll be Excel videos in this course to help you too, which I'll talk about later on. But it is worth your while to know it now. And as I said, I'll go through a bit of an overview of the portfolio management and the investment industry in general. Any questions so far? If you have any questions, by the way, please do just, you don't need to even, don't bother with your hand, just shout them out. You can put your hand up if you want, but you'll find I ask you guys a lot of questions as we go through. I'll never pick on someone and make them answer it, but the more that you guys sort of all chime back at me, one, many, doesn't matter, the more interactive it gets and the more interesting for you, because I wouldn't want to sit and watch me talk for 2 hours. It's much better to have a bit of interaction as we go. All right, so what we do in this course is we look at portfolio construction at the overall plan level. So first of all, how would you guys define a portfolio? Does someone want to give me a definition broadly of what you might call a portfolio? Yeah, that's right. It's a collection of investments that you've chosen to generate a return, hopefully meeting the other desirables, if you like low risk, relatively high liquidity, you might want capital gains, you might want an income stream. You decide what you want out of the portfolio, and then you create your investments to match those objectives and constraints. So let's say, for example, we're going to look at the broadest, because what we do in this course is what we call the overall plan level. So let's say that we start with the asset allocation task. If we're looking at putting a bunch of investments in our portfolio at the asset allocation level, what type of asset classes might we talk about? Debt? Yeah. What else? Equity? All right, so public equity and debt are our two traditional asset classes, and they're what probably up until now you guys have spent the most amount of time on. So we call them traditional. Does that work? Yeah. So we've got public equity, and we've got public debt, and in this course we tend to call that fixed income. This is essentially the starting point when it comes to considering asset classes, and for a very long time they made up, well, they still do make up the majority of people's portfolios. For a long time they were essentially the entirety of their portfolios. But what we're seeing in terms of a trend is more and more people are moving into what we call our alternative asset classes. Does anyone want to give me an example of an alternative class? Real estate? Yeah. Or we might call that property. And what we're going to see in this course is we've got two types. We've got direct property and we've got listed property. And we'll see that they perform differently to an extent, so that even though they're both property, at least in the short term, they can be quite valuable diversifiers when it comes to forming a portfolio mix. What else might we have? Commodities? Any others? Hedge funds? Yeah. Hedge funds are funny because people sit there and go, why are hedge funds an alternative asset? Because it's not the hedge fund that's the asset, they invest in equities. But the fact is, in industry, and that's, remember, the focus of this course, when people allocate their money among different alternative assets, they have a hedge fund bucket that they fill in the same way as they have a commodities and a real estate bucket. Any others? Sorry, say that again? Yes, private equity is another big one. And that's why I defined it as public equity in the traditional, right? As we're going to see in week 9, again, both public and private are talking about equity, ownership in a corporation. But because the dynamics of private equity are very different, right? You've got general partners with a big involvement in the running of the company. So that's a big advantage. But on the other side, you've got much lower liquidity, right? The secondary market in private equity is very illiquid. Because they have different exposures and features, they're, again, quite good diversifiers to combine in the portfolio, providing you can access private equity, which isn't always the case. There's also things like infrastructure we'll look at. Right? Infrastructure is a really big thing to look at when you look at superannuation, because the long life of infrastructure ideally suits the long life of superannuation. I love infrastructure as an asset class. It's one of my favourite. One of my favourite things to study. It was one of my favourite things to do when I've spent a bit of time in industry, and it's one of my favourite things to teach. But more and more, I've started to really look at infrastructure and try to get rid of what we call the typical or the stereotypical view, right? Because a lot of people, when you talk about infrastructure, they go, oh, yeah, sure, roads, first of all. Roads that have a steady cash stream, they're expensive to set up, but once they set up, you've got tolls, so it's got a good steady income, maintenance is pretty low, so it's pretty safe. You know, it's a stable cash stream, safe cash flow, right, whichever way you want to look at it, low risk asset class that really doesn't go wrong. That's really dangerous because some infrastructure projects are like that. But first of all, roads is just one subset, right? There's so many other, you've got utilities, you've got telecommunications, you've got social versus economic infrastructure. But two, even within your toll roads, some projects can be very valuable, others can completely fail. Anyone ever been through the Cross-City Tunnel in Sydney? Well, you might be being quiet and not answering, or you might just genuinely not have been through it, and I'd believe it, right? Because the Cross-City Tunnel is one of those unfortunate examples of an infrastructure project that looked really useful, right? It connects the east and west of Sydney. The initial usage said, all right, it's going to be expensive, but people will use it. They will pay the tolls. They will get the return to generate to pay back the cost of the project. So they built the tunnel. And it wasn't convenient enough to justify the tolls people would have to pay. Because people don't like user-pay systems, right? I mean, let's face it, you go to Sydney, you'll probably grumble when you're in a bad mood that you have to pay the toll on the M5, right? We love big roads, we use them, but for some reason, and I'm included in this, we kind of resent having to pay for them, which is a bit unfair, but it's the reality. So if a toll road is going to generate a good return, it has to be essential. And in the Cross-City Tunnel case, people just went around it, right? The usage was way lower than what people thought. And the result is that the company that actually did the project went into receivership. Okay, so a bad infrastructure project will completely lose. The return will be really devastating. Okay, so it's important to pick your projects carefully. As you can see, I do love infrastructure, so I tend to waffle on about it a bit. All right, so these are the type of alternative assets that we'll be looking at. So we'll look at public equity in week 6, public debt in week 7, real estate and infrastructure in week 8, and these 3 in week 9. And then in week 10, we're going to look at the currency hedging decision and essentially how things change when we look global to our investment set rather than stay local. So that's why I say that we look at this course at the overall plan level. Right? A lot of portfolio construction courses will focus on one asset class, typically equity, and they'll spend the whole time looking at the specifics of how to undergo an equity investment and form an equity portfolio. That's not what we do. We sit at the top of an umbrella, if you like, usually taking the perspective of a superannuation fund. We also look at things like endowments and foundations and insurance, but most of the time we focus on super. And we say, all right, well, you have a bucket of money in this superannuation fund. The first thing you need to decide is how to spread that money between the different asset classes, like the ones I just wrote down. Only once you figure out how to spread the money amongst the different asset classes do you then focus on how you invest the money within each asset class. So that's the path this course takes. The first 5 weeks is on the asset allocation decision. Then the next 5 weeks is on the specifics of each individual asset class. And then we finish with a look at things like implementation issues, taxes, governance, and the extra things that are really important when it comes to running a fund. So again, it has a very applied focus. It's all about how the theory meets practice. And as I said before, a lot of the time that might end up being all of the theory that you learnt in these courses doesn't actually work the way we'd like it to. For the simple fact of things like people can't borrow and lend at the same rate. So we look at what works in reality. I think I talk about that, in the next slide. In terms of jobs where the learning will be useful, I mean, the most obvious application for this is if you end up managing other people's money. If you end up in the asset allocation decision of a super fund, if you end up within an equity or a fixed income fund. But it's also relevant if you end up in things like asset consulting, right? So that's your Towers Watson, your Mercer, financial planning on the retail side, or essentially anything which is peripherally connected to managing investments. So it might be things like you might end up as a broker or an equity research analyst, because it gives you an idea of how the overall industry hangs together. So a bit later on, a lot later on, we're going to go through this diagram to give you an idea of how the industry works. And if you end up anywhere connected to one of the points on this diagram, hopefully you'll find that the material in this course will be very useful. In terms of my background, so I'm obviously an academic. Most of my research is actually on equity investments, and we'll talk, some of my research I'll bring in a few weeks' time when we talk about whether you want to go active or passive, because that's a big thing that I look at. Can anyone tell me, what would a passive equity fund do? Yeah, it's just going to track a benchmark, right? So you're going to pay low fees to get exposure to a broad equity benchmark, so, or a universe of stocks that are very similar to the benchmark, right? Sometimes if it's a huge benchmark, you won't have investments in every stock, but you have it in most. So essentially you're getting a low-cost option to get a diversified equity exposure. But you're not getting any what we call alpha. That's the focus of an active fund, right? So an active fund will try to actually outperform the passive fund by investing in particular stocks that they think will outperform. But there's a trouble with this. Let's take the US, right, the biggest market in the world, and let's look at US active equity funds. Can anyone tell me, does the average US active equity fund out or underperform their passive counterparts? Underperform. So we've got a massive issue here, right? We've got an industry which is charging huge amounts of money and growing every year. And yet the average manager in this industry is failing to do what it is they claim to do, outperform their benchmark, right? So a lot of my research looks at, all right, well, if you are going to go active, how do you pick your active manager? And do you always go active? And in my view, the answer is no. Because there are some times where all of the stocks in a market are performing in a really similar way. So you can be as active as you like and pick some stocks, but if they're all the same, you're not really differentiating yourself in performance, but you're charging investors a lot of fees, right? So as an investor, I wouldn't want to spend a lot of money in times when, even if my manager is being really active and getting good stocks, they're not really much better than the average stock. So actually, once you take into the account fees, you're underperforming, right? I want to put my money with an active manager when stocks are doing really differently. What we call cross-sectional dispersion is really high. Because then, if my good manager picks the best stocks and avoids the worst, that's going to have a massive impact on the performance of the fund relative to the market, right? So it's all about which active managers you pick and when. So I'll talk a little bit about that later in the semester. I always knew I wanted to be an academic, so I basically did every internship I could get my hands on when I was a student. So a lot of what I talk about with infrastructure is because I spent some time at the Treasury in their infrastructure department. I was in London for a bit with Schroders in their quantitative equity products team. So that's a quant equity fund, not what we call a qualitative strategy. What's the difference? What will a quant fund do? Or what will a qualitative fund do? If I'm a qualitative manager or a fundamental equity manager, how will I gain a view on whether a stock is a worthy investment? What type of things might I do? Hey, guys in the Hayden Allen tank, any answers? Sorry, I'm only kidding. Sorry, guys, I know you can't answer it. So basically, if you're a fundamental manager, you might visit the company, you're going to pore over the financial statements, you're going to gain a view about whether a company specifically is undervalued by spending a lot of time face-to-face getting a view of its operations, its future, if it's rolling out divisions, if it's getting rid of divisions. If you're a quantitative strategy, then what you're doing is you're creating proprietary models that really is just sitting behind a computer screen. You've got a head involved, you're checking that your answers make sense, but you're trying to find through regressions models that will pick a number of different identifying factors, momentum, earnings revision, whatever it may be, feed it into the model, and what will spit out is rankings or values that will enable you to rank stocks from the most expensive to the cheapest. And you're going to buy the cheapest, sell the most expensive, and then continue to adjust your model. So we'll talk a bit about that in week 6. I've also spent some time with Continuity Capital Partners, which is a private equity firm. And remember, as I said, private equity and public equity can perform very differently. Because private equity, you've got a general partner, right, that's the private equity fund, that gets money from a bunch of limited partners, pulls it together, and then has big, high proportion investments in these equity companies. In these companies. Now, that might be a startup that doesn't really have a lot of capital or know how to get going. So you provide seed financing and have a big say in how that company brings its product to market. And then when the company becomes established, you help the company go public. Or it might be that you have a public company that you don't think is actually operating efficiently in its publicly listed form, right? Ownership dispersion is too wide. It's not being run as well as it should. And so you do a big buyout and take that company private because you think it can be run better in a private way. So we'll be looking at that too. We have 2 tutors, Khadija and Badia. They're both fantastic. You guys will become very used to these Excel online videos that I'll talk about later on. The voice in those videos is Khadija. She's been tutoring this course with me for many years and was involved in creating the videos that will be a big part of this course. They're both fantastic tutors. I think you'll have a lot of fun with them. I'll let them introduce themselves to you in the first tutorial. And the last thing is, we've got a combined undergraduate-graduate class. For the most part, it's not going to make a difference, right? We're in our lectures and our workshops together. Tutorials are split on undergraduate and postgraduate lines, and there are some differences in assessment. Specifically, the big difference is going to be the exams, right? The exams will be similar, but they won't be exactly the same. There'll be questions that are different in the undergrad and graduate cohorts. One won't be aimed to be more difficult than the other, by the way. They're just different. And the assignment, therefore, also needs to be formed within your undergraduate or your graduate cohort. The assignment is actually going to be the same for undergrad and postgrad students, but you still need to if you're undergrad, you only need to be with undergrads. If you're postgrad, your group has to only be postgrad because we need to keep that clear division in assessment items. So I'll give you lots of reminders of that, but you can't have an undergrad, postgrad combined assignment group. Any questions? All right, so the broad approach for this course is all about getting an understanding and appreciation of issues. It's not about me trying to get you guys to memorize facts and theory. Everything that we do in this course is going to be tied to examples, and that's really important because remember, the one portfolio isn't going to be right for everybody. So that means that this isn't one of those courses that you can get away with just rote learning the material. Because even if you rote learn the lecture slides, the exam questions and the assignment are going to ask you to apply that to different situations or provide different examples. So it does mean that it's a little bit extra work on your behalves, right? Because you can't wait till week 12 and just memorize everything we've done. But it also, I think, will make it more valuable for you because you'll gain a much richer understanding of something that you are going to be using in your everyday lives. And in doing it, the focus is always going to be on solutions that work in practice. So let me give you a couple of examples on what I mean by that. So in investments, you guys would have done modern portfolio theory, right? remember this very, very pretty graph where you've got expected return, you've got your risk. What's this line called? Portfolio frontier, efficient frontier from the mean variance portfolio up. And then remember, we get a line tangent. Let's pretend that's straight. We get a line tangent to the efficient frontier. What's the point of tangency? What's this? Yep, the market portfolio. What's the line called? I heard it before, capital market line. And what this creates is what we call two-fund separation theory. I love this theory. It's a beautiful way of looking at the world. It just doesn't reflect reality whatsoever. Because what two-fund separation theorem says is that every single person in this room, in this country, in this world should only be investing in two different assets. The market portfolio and what I forgot to write in, which is the risk-free rate. First of all, that would imply that every single person in this world could borrow or lend at the same rate as everyone else, right? So my borrowing rate will be the same as your borrowing rate and the next person and the next person. Not true. Second of all, that would imply that people can borrow and lend at the same rates. Not true. Anyone that can get a mortgage rate or any kind of borrowing rate that is even close to what we're stuck with in our bank accounts, please tell me, because I want that mortgage, right? There's no way that borrowing and lending rates are going to equal, or the market wouldn't function, because someone needs to be capturing the spread. Look at the market portfolio. It would mean that every single person would have to invest in every single asset that exists in the market in the proportions that they exist in the market. And I don't just mean stocks, I mean the market. So we're talking stocks, bonds, commodity, property, infrastructure, private equity, hedge funds. Now, first of all, can anyone invest in a hedge fund? No. You need to be a high net worth individual. So straight away, we've got people that aren't classed as high net worth not being able to access one of the key asset classes. You could, I mean, you can, you're not outlawed, or it's not illegal to invest in a private equity fund if you're a small investor, but it's blinking difficult to do it, right? Because private equity funds, they market to their existing clients. They market to big names that help them sell the fund further, right? So it's hard for mum and dad investors to get access to that type of thing. If you're a big company, you can't go and put your money in a super fund in the same way. Right, so you can see that not everyone can access the same opportunity set. So this curve is not going to look the same for every investor. So that's what we do in this course. We say, okay, here's the theory. Here's why the theory doesn't work. And then what can we use of it? Because you don't throw it away. There are really important messages in modern portfolio theory. Diversify. Correlation matters. Things should be viewed in both a risk and return context, right? But then we need to actually take those lessons and apply it in a more practical form. And all of that is going to be tied into the individual objectives and constraints of the person that you're creating a portfolio for. Okay, so that's one example. The other thing in terms of focusing on things that work in practice is that sometimes things that you think might work in practice don't actually work as time goes by, or have issues that arise through time. The classic example of that is this year, right? This is the first time I'm taking this course since there's been that review into superannuation. For the past 5 years, when I've been taking this course, I have been going on and on and on about the wonderful thing that is what we call a life cycle fund in superannuation. Can anyone tell me what a life cycle fund is? Okay, so, and by the way, it doesn't matter if you haven't heard of it. We do it in the course. You probably haven't before. But remember how we spoke about the example of your asset allocation versus your parents, and the fact that when you're young, you can take on a lot more equities in your super portfolio than when you're about to retire, when you should have a safer allocation with more fixed income, right? All right, so you guys are learning this. You're doing finance. So let's say that you start up your super fund, and you're asked to choose, because in Australia we have what we call member investment choice, right? You can choose the type of fund you go into and often the policy within it. So you go into your super fund and you say, I want an aggressive, high growth strategy with a lot of equities. Because you've learned that when you're young and you have decades to retirement, providing that your personal risk appetite will afford it, you can have a lot of equities because you have the time to ride out the market cycle. So you've made that decision. It's probably a very appropriate decision for you at that age. Hopefully, because you're clued up into the industry, you're going to remember that as you get towards retirement, that needs to be tweaked, right? You go away from high growth into growth. You go towards balanced. You go again towards conservative. I would bet you money that at least half of the people in this room may not remember to do it at the right time. And I'm saying that because I know for a fact that I won't, right? And I teach this every year. Now go away from it. Think about your friends that don't learn finance, that hate finance. I have friends that when I talk about finance, their eyes just glaze over. They don't want to know, like at all. Now let's say that they had a super fund and someone, probably me, told them, look, be in high growth, you're young, right? And they said, okay, fine. Are they going to remember to adjust their allocation? The risk is no. The risk is that they start high growth and they stay high growth. They hit 60, they hit 65, they're about to retire, they've got a lot of equities and the market goes down. And suddenly they thought they were retiring comfortably and they're now really squeezed. Some people may not even be able to afford to retire, and that did happen in the GFC, by the way. They're going to wish they thought to adjust that allocation, and that's what life cycle funds will enable you to do. It's this beautiful concept, particularly for anyone absent-minded like me. It tranches people by the time that they have until maturity, and it automatically adjusts the portfolio allocation as they age. It does it for you, so you don't need to worry about remembering to do it yourself. Right? I love this idea. I have been teaching it and emphasising it every single year. This year, there has been a review into superannuation. The report is still in draft form. But one of the big findings in it is that life cycle funds, which, by the way, are 1/3 of the MySuper offerings, right? Australia has taken it up in a big way. In reality, life cycle funds on average have left a huge amount of money on the table. Investors would have actually been better off in the more traditional offerings that don't automatically adjust. And the reason is that actually what's been happening is that people have been tweaking towards safe allocations way too early. Often as early as your 30s, they've been adjusting it to go safer, right? So this great concept that should work so well in reality actually is turning out isn't doing so well. I'm not ready to give up on it yet. People just need to tweak the formulas. And it is a learning process, but it's really interesting. Even things that make sense in reality don't always eventuate in the same way. So you've always got to look at what's happening in the industry, what's changing in the industry, to figure out what's working in reality. Now, if I go back to the slides for this next point, and I think you guys have probably figured this one out already, it is the introductory lecture, so it won't be quite as extreme as what you're seeing so far today, but the PowerPoint slides provide structure, but around that, I talk about a lot of examples, right? And they can't all be on the PowerPoints. Often, there might be something I've heard on the weekend that I bring up in the lecture. So the PowerPoint slides will probably feel pretty thin compared to your more traditional early finance courses because we spend a lot of time talking about it, which means that you guys will need to listen, ask questions, think about it, take notes, maybe go back and listen to recordings. And by the way, if a recording ever fails, and hopefully it won't, but if it does, I promise you I will retape it. I'll go into a room with no one in there and just do the lecture again. I've had to do it about once a year. It feels really weird, but you will always have a recording for every lecture. But it does mean that I hope you guys will really connect, write down what we're talking about, listen to a recording if you didn't quite understand, ask questions as we go. And there's another reason that I make sure I don't put everything we talk about on the PowerPoints, and it isn't to try to make people miss stuff. I don't want you to miss anything. These are taped for a reason. It's that I don't know about you guys, but whenever I had courses where everything I needed to know was written on the PowerPoints, one, I probably wouldn't turn up to lectures. Two, I wouldn't read a lot or do a lot until week 12. I would then take those lecture notes, I would learn every blinking dot point on those slides, and I'd walk into the exam, It actually wouldn't hurt my grade because I learned pretty well, which is not really something to be proud of. But, you know, I walked in and I said what I needed to say. But if I'd taken that exam a week later, that mark would have gone to a fail, maybe a pass if I'm lucky, right? When you learn, you don't understand. And when you don't understand, you don't keep the knowledge with you. So a lot of the way this course is structured is to try to get you guys to really digest it in a way that 1 to 5 years from now, you'll still have that understanding that you won't have gained if you just memorized the content. But it does mean, if you have questions or clarification, ask them as the weeks progress. It's not a course, remember, that you can memorize in week 12 and get an easy HD. So the lectures introduce you to the concepts, gives you practical examples, and then the tutorials and the workshops and the online videos that help will address specific issues and tasks. So for example, in week 3, we look at modern portfolio theory. I talk about modern portfolio theory, its enduring messages, because remember, it doesn't work exactly in reality. And then I talk about how you might use those messages to form a portfolio. We talk about mean variance optimization and the issues that can result. And then we look at how you might want to build what we call a portfolio analysis workhorse that avoids the optimization technique. So we talk about the tools, we give examples, then you're going to look at your Excel online video, which I'll come back to, and your workshop, we're going to work some more on it, on how to actually do mean variance optimization, right? So we take the concept and we apply it to real industry methods, using real data in Excel, and then from that, you're going to come up with an outcome from the optimization task you've been set that you're going to analyze in the tutorials. And the assignment is another avenue in which you're going to apply what you've learned. I'm going to give you an example investor that has a portfolio, and I'm going to give you their objectives and constraints, and you're going to tell me how you would improve that portfolio. So the advice, and I say this a couple of times through today, but it really is going to be the difference between coming out of this course with an understanding versus a rote learn, is to listen, talk about it, understand, and think. Right? You want to link all of these topics together because portfolio construction is multifaceted, right? It's not one of those courses where we say week 1 is self-contained on this, week 2 is self-contained on this. Each week ties together. So you've got to continually build up your understanding as you go. The assessment, now by the way, there is a change. If anyone downloaded the lecture notes before today, I had optional and redeemable in there. My apologies, that was an artifact of a past semester. It is not optional, but it is still redeemable. So it kind of doesn't matter whether it's optional or not, right? If it's redeemable, even if you don't turn up, it would just mean everything is based on the final. But I actually think it's because we're not allowing, the university isn't doing optional exams anymore. I actually think it's a really good change because the fact is, it'd be so stupid not to go to a redeemable exam, right? Even if you haven't studied, you get 0. Who cares? We'll just take your final. But by doing the redeemable exam, you learn how I write exams, and they are quite different in this course, right? It's multiple choice and short answer questions. And the mid-semester will be similar in structure to the final. So that will give you exposure to what the final will look like in its style. It gives you an idea of how you're going, whether there are areas that you don't understand, whether perhaps what you thought was a sufficient example needed more elaboration. So, for example, a really common thing I see in mid-semesters, if I ask a question, let's see, what's a good one to provide an example of? I'll say a question like, what is the difference between a dynamic asset allocation and a tactical asset allocation strategy? And please provide an example. And someone might say a dynamic asset allocation strategy is this, e.g. strategic tilting. And I'll say, well, yeah, but that's just a name, right? That's not actually the example. And so you'll see that what you thought was providing an example isn't enough in this course. You need to actually outline the example. Strategic tilting because you think that the investment environment or the investor's circumstance has changed and you provide an illustration to show that. And you'll get lots of practice at it because that's what we're going to be doing each week in the lectures. So 25% mid-semester exam. If you do better on the mid-sem than the final, then it will be worth 25%. If you do better in the final, the mid-semester will be worth 0 and the final will be worth 75%. A couple of other things about the mid-semester and the final. One is that in the mid-semester exam, you get to take a single A4 page of notes with notes on one side only, can be handwritten or typed. And in the final, you get one A4 page with notes on both sides. Hopefully that pleases everyone, but it does drive home what I said before. This isn't a course where you're going to get 100% by regurgitating the lecture notes, because if that was the case, you'd just copy it down onto your cheat sheet, copy it again into the exam and walk away with an HD. And that's not really learning anything. You might actually have to repeat what's in a lecture slide, but then provide examples and illustrations as well. And I'll talk about that lots when we do exam preparation in about week 4 or 5. In about week 5, I think I'll do it. What else? So the mid-semester and the final will both have some multiple choice and some short answer components, and they will ask you to apply things to different scenarios. That's about it for now. I'll talk more about it in week 5. And you're going to have a 25% assignment. That's in groups of 4 to 6, and it is self-selection. Now, during this week, I will open up the assignment group feature on Wattle, where you actually, when you've got a group, it's not enough to just decide, you've got to actually go and register as a group on the Wattle site. It's not live yet because when they changed the tutorials, I lost all my groups, so I've got to redo it. But if we go to assignments, the assignment groups, that link here, later this week that will go live and you can actually register your assignment group in that link. But you guys have until week 5 to do it, and I've put the deadline in the announcement, but please make sure you do register by that time. And once you've registered your assignment group, you are in that assignment group. Do not try to change after week 5, because by then you guys will have started to work on things, and you get a lot of contentious issues by people saying, I did a lot of work, and then my assignment group kicked me out, or whatever it may be. There's inevitably going to be a circumstance where some people are not happy with some people in their group. All I can say to that is so frustrating, and I do sympathise, but that self-selection factor, you're never going to get that again once you leave university, right? When you go into the real world, it is very rare that you're going to choose the team you operate in. And chances are that you're going to have someone in that team that you don't work well with. This is a great case in a safe environment to learn coping strategies and actually end up with a good outcome. So if you have frictions within your group, by all means come and see me and we'll work on ways to help get to the end result of your report. But once you've got your group, it's set by the end of week 5, it should stay that way. The exam questions, so it's going to be material in the lectures, workshops, online videos, tutes and examinable readings. There are 2 types of readings, examinable and supplementary. Examinable readings are obviously examinable. I'll come back to it, but it's all about just identifying the key messages of those readings. Some of it is also from the textbook of the course, but I didn't want everyone to have to purchase the textbook if they didn't want to, because I know that that can start to get expensive. If you have a look at, where have I put it? Hold on. Here we are. FPH examinable readings. So in the textbook, there's only 10% of the textbook that is examinable, because that's the biggest percentage I'm allowed to let released online. But if you go in, you can see those readings here. I really should have checked this. I remembered how to do this. What do I do? Is this materials for the course? Okay, I can't remember how this comes up, but I know it works. So I checked it a couple of weeks ago. All right. If anyone can't pick, internet, online, got it. Okay, excerpts. So that last thing, I was about to say great, I'm looking like such an idiot right now. All right, so this last bit where it says excerpts, if you click on that, these are the parts of the textbook that is examinable, and you can just download that and print it off yourself. And the online videos and tutorials are also focused on establishing a base for the assignment. In particular, The first 4 online Excel videos, and that's weeks 2 to 5, the Excel work is geared directly towards helping you do the assignment. So it's really important that you do those as the weeks progress. So to talk about the assignment a little bit more, it's all about formulating advice for a particular client. Now, just to be really clear up front, and I'm sure no one would have ever considered this anyway, every semester the client changes, right? So remember how I said a different person will have a different portfolio that's right for them? That means that if you happen to have known someone in a past semester that did the assignment and did very well with that asset allocation would not be suitable for the current assignment. Okay, so you actually will submit it on Turnitin, so there is all those checks, but don't take, even if you look at a past assignment because your friend says we did really well, don't assume that that allocation is a good allocation for this one, right? Because with different clients, each time they have a different job, a different preference for, say, Australian versus international assets, a different time to retirement, a different risk appetite. So the answer to the assignment will always change. Even though the focus is the same, how do I recommend a portfolio that's right for this client? The actual portfolio is different. There's no one right answer in the assignment, right? I don't expect anyone to come up with an identical allocation. What I care about is broadly, is the allocation appropriate, and how have you justified and explained that allocation? I'll give you the assignment in about week 5, and then by week 5, when you have the assignment, you don't know enough to actually do it yet, but you'll know enough to start thinking about it. So I hope that you'll start to think about a plan over the semester break, the mid-semester break, and then from week 7 to 10, we have assignment workshops, where the goal of those workshops is about helping you with common problems that will come up in the assignment. Some of these are problems I already know you guys will have, so I'll put those through the weeks. I'll put those already into the workshops. But the other thing I like to do, and by the way, this applies to workshops in general, if there's something you don't understand, let me know, and I'll gather those and actually put them into the workshops, because if you've got the issue, probably other people do as well. I like the workshops to sort of evolve depending on the issues that come up with each semester. So they're never exactly set in stone. I'll often change them a couple of days before we actually go in to fit together the different problems that people are having. What that does mean, though, is that when it comes to the assignment, all questions will be answered in the workshops if humanly possible. In other words, if you have a problem that's a general problem that applies to everybody, let me know, but what I'll say is, thank you for letting me know, I will put that in the workshop and answer it for the whole group. The reason is that otherwise I'm going to be answering the exact same thing about 50 different times, which is obviously not efficient, but more importantly, there'll be some groups that have the question but don't feel comfortable coming for help, and I want everyone to have the same amount of help from me, right? Because at the end of the day, some people just won't want to ask for help and others will be very comfortable doing it. I don't want that to create a natural disadvantage. So I want to be providing equal information to all groups. Now, if you do have a specific issue with your spreadsheet, right, perhaps the way you've set it up, you're coming up with an error message, or you think it's not linking properly, then see me individually and I'll work with you one-on-one. But general issues, I'll answer through the workshops. Due 3 p.m. week 11, Wednesday 17 October. Please hand it in by 3 p.m. If it's late, the policy is that you get 0. So please hand it in on time. You need to sign up to your group by the end of week 5 within the cohort, undergrad or postgrad. And the online Excel videos are very important to help you guys do the assignment. So let me actually go into the Excel online videos and talk about that a bit. These have been around since the start of 2011 because I actually got a grant to create these, I did it alongside Khadija, who will be one of the 2 tutors. It's her voice in them. She was brilliant in putting these together. Essentially, after a few years of teaching this course, I just got the feeling that the tutes weren't working. And the reason is that the tutorials were all about, here's an Excel spreadsheet that is about a specific problem related to the course content. So maybe running a bootstrap or mean variance analysis or evaluating the difference between value and growth stocks. I give you the spreadsheet, I give you an outline of what to do, Hopefully you'd attempt it before going in, but then everyone would go into the tutes, they're in normal tutorial rooms. Most people didn't bring their laptops, which is understandable. The tutor would have a screen where they did it in front of the class, but the class couldn't follow it because they didn't have their laptops, and if they got lost about a third of the way through, that once you get lost in watching an Excel process form, you can't make your way back up in the time. So you'd end up not knowing how to do it, then you'd go home and not be able to listen in because they're not taped, and so it's very hard to remember the steps the tutor took. So I felt like that actually ended up meaning that most people were spending an hour each week, a good chunk of that potentially being wasted time because they weren't learning as they were going. So what we did is we created Excel videos that are released every week after the lecture that actually take you through step by step that exact Excel problem. So what happens is you'll be given a sample, so you'll be given an analysis file that you need to learn to fill in, and you'll watch the video, and you'll also have a guide to help you as well, but you'll watch the video and Khadija will talk through the formulas and the steps needed to produce the solution. She'll be doing it in the video on a dummy data set that's shorter than your actual data set, which is updated to 2017. So you won't get the same answers as what's in the video, but you'll be doing the same steps to produce your own relevant answers on the up-to-date data set, right? Because I didn't want it to be about replicating the answers, because I want you to find the answers on your own. But it will tell you the steps that you take, you do the formulas, and you apply it to your data set. That way, if you don't understand, you can pause the video, you can go back to the video at a later date, and you can take your time in learning how it works. Hopefully you will do that before going into the tute, because the other change that goes along with it is we don't have weekly tutes in this course. The way I do it is that there are fortnightly tutorials instead, because the tutes are now only focused on interpreting the outcome of the Excel files. Right, so you do the work, you get your answers from Excel, you check that, by the way, you also have a solution file in Excel so you can be sure your answers are correct. Then you go into the tutes and you discuss interpreting the results. You know, here's the outcome of mean variance analysis or portfolio optimization. Why is it that without certain constraints, I have crazy corner solutions where I'm, shorting 200% of my portfolio in world fixed income, right? So you start to analyze it. Now, I believe Hua, who is the other lecturer that takes this course, I think she uses the videos that Khadija and I created but keeps weekly tutes. I do only do fortnightly tutes because that was the way we structured it. We wanted to be time efficient. We didn't want to waste your time by having you in there every week, and we wanted you to be able to look at the videos in the comfort of your own home when you felt like it. But that said, it does mean you do need to do that work at home. So this is always an experiment, and I'm always looking to improve it. If you wish that you had weekly tutes, that is valuable feedback for me. Let me know. So far, so when I piloted this at semester 1, 2017, people liked the fortnightly setup. But if you guys would rather the weekly tutes, I can't change it now, but I can change it in the future, right? So I think this is a better setup, but I do want to know if you disagree. But essentially the deal is, if you guys are committed to being happy to be able to do that work at home, in your pajamas, in bed or on the couch, whatever, but looking at the video, you only need to be stuck in tutorials once every 2 weeks, not once every week. And by the way, don't just look at the solution file and backward engineer how to do it. Try it on your own first, then check that your answers are correct. So then you've got fortnightly tutorials. So you will either sign up to a tute which you will attend in even weeks or in odd weeks. So Group A tutes are going to be in 2, 4, 6, 8, 10. Group B tutes are going to be in 3, 5, 7, 9 and 11. Now the only thing to realise with that, therefore, is that the solution files from the tutorials, if you're in Group A, you'll do your tute in week 2. The solution file will be released at the end of week 3, just because even though you've done it in week 2, some people won't do the tute in week 3 until week 3. Otherwise, there's no advantage or disadvantage in being in Group A or B, because I make sure that none of the topics covered are essentially, you don't need to talk about anything in a tute that you haven't yet done in the lecture. So there is that bit of a lag in terms of what's dealt with in tutes versus lectures, but it means that if you're in week 3, You're not going in week 3 discussing material that you only happen to learn that day or anything like that. So tutes will not be about how do I do this in Excel. Tutes are about how do we interpret the findings from Excel. So it is really important that you try those Excel spreadsheets first. Any questions on the tutes or the videos? Remember, tutorial enrollment opens at 10 o'clock tomorrow, I've been told. If there are problems with your enrollment, please don't send me 450 emails saying that there's a problem. If there is no time that works with your current schedule, then what you should do is go to the Level 4 CBE building to our wonderful administrative team. You need to show evidence that says I actually can't attend whatever tutorial is left remaining to me, so your timetable or whatever it is, and they will try to help to enroll you in a tute that doesn't clash with your schedule. All right, seeking assistance. As I said, the assignment workshops are used as the main forum. So if you ask me questions and it's something I think applies to everybody, I will take them, gather them together and put them straight into the assignment workshop. And then if you have follow-ups, by all means, come and see me one-on-one. Assignment-related questions should come to me. Lecture and workshop questions should come to me. Questions on the tutorials or the online videos should go to your tutor. Here's another change. My consultation, sorry, originally I had the wrong time there. My consult this semester is Wednesday 3 to 5 after the workshop. The tutors will tell you their consult times in the tutorials. And the other thing in terms of getting help I wanted to say is if you have a complicated question, try to come and see me rather than use email. Because typically what will happen with email is that I'll miss cues that we could get in a conversation that mean that I haven't actually explained it in the best way I could. Right? You might email me and say, Anna, I wasn't quite sure what you meant when you discussed Keynes's theory of normal backwardation. And I might provide you with this really long, elaborate response that took me about an hour to write that basically goes over what I'd said in the lecture, and you would think, you'd get it back and go, yeah, I didn't mean that. I meant something completely different. And sometimes people are too hesitant to actually say that in an email, to come back and say, no, that doesn't answer my question, try again, which I hope you do, by the way. If I don't answer your question, I want to try again, because often I'll have to explain things a few different ways until it clicks. We all think differently. But the fact is, I don't know whether my answer was right for you because I don't get a response. Whereas when we're face-to-face, if it's complicated, it's quicker to discuss face-to-face. And if I'm losing you, I can typically see it because you start to look at me and vague out and have this look like I'm really not helping you or I'm slightly crazy, and I can say, all right, this isn't right. What is it that you don't understand? And I'll try again. So if it's a simple yes, no question, send me an email. If it's something that requires discussion, come and see me. And same thing goes for your tutors. I've gone through all of this already, but just quickly, it will be important to engage with the lectures and the tutes. Lectures and workshops will be taped, and I will retape it if there is a technological glitch. But the only thing that will be posted for the tutes is the summaries. And these are summaries, and remember, I wasn't in the room. So a lot of rich discussion that happens in tutorials won't be included in the summary because the summary is just what I expected you guys were going to cover. So make notes in the tutes as you go. Do the readings, extract the key concepts. In the examinable readings, it's all about understanding the central message, right? If there is a formula in an examinable reading that we never discuss in any class or in the videos, you don't need to worry about it, right? It's all about what relates directly to the classes and also what the central messages of the readings are. Supplementary readings are not examinable, right? They're there because I think you might find them interesting, or because they might help you answer a tute question like in the first tutorial, or because it might help you in the assignment. So cherry pick them as you need and as it interests you. And the textbook, it's only the examinable readings that are online. If you want a supplementary reading, you can either purchase the text or there are some in short-term loan in the Chifley Library. And the other thing is, please do prepare for the tutes. You will get so much more out of them if you prepare than if you just show up and listen. And that includes working on the Excel stuff. Now, the other thing is, I want to talk about what other students before you have found with this course. And it's not to scare you or anything, it's really just, I think it's important to set expectations early because it will help with your strategy in this course. I love this course, and I think on the whole, people do connect with the material in it, right? People find the material practical, interesting, they find the assignment engaging. But I didn't put that there just to say, isn't this a great course? I actually wanted to focus on the latter half, which is the challenges, particularly at the start with this course. It's considered a hard course. It is a 3,000 level or an 8,000 if you're postgrad course. But I think the main reason it's considered hard is that there's a lot of different materials and concepts that you need to bring together, written from different perspectives, right? In early finance courses, you've got a topic that's the focus of the lecture that relates to a specific chapter in the text. At the end of that chapter are the questions you need to answer. Here, you've got different readings written by different people with different perspectives. You have my perspective in the class, you have your tutor's perspective in the tutes, and then you apply that to actual Excel files, and we talk about specific examples. And the different weeks interrelate. So it's a lot of material to bring together, which leads to confusion over how to study for the exams. Now, I'll talk about exam prep a lot when we go through the revision. But as a heads up now, the way to study, the way to actually gain a good understanding of this course is to essentially just keep at that material as the weeks go by. Don't leave things till the end. Because once you can if you can actually do mean variance optimization, you're going to understand the concept that much better because you've done it, right? If you've read the examples, when you think about a concept, you'll know how to define it, even if you haven't learned the definition, because you'll go, yeah, I understand how that relates to Telstra, or I know how that really mattered in the GFC, right? Because every time you bring in another layer of understanding, be it examples, be it practical applications, you're going to get a richer understanding of the overall course. I've already said all of this, so I don't want to harp on, but that essentially just summarizes what I said. You need to understand it, so make sure you do the readings and the Excel work as you go through. You really don't want to be leaving that till the last minute. All right, so that's it for the course overview. Any questions on that? Okay, so I am going to ask you guys a question that will determine what we do from here. It's 3:15. We've got an overview of what you're going to cover. Do you want a 5-minute break, or do you want to push through to the coverage? And I'm going to ask for a show of hands. I'm sorry the Hayden Allen tank, blame these guys if they say the wrong thing, but show of hands, who wants a break? Who wants me to push through? Okay. Hayden Allen tank, if you don't like it, find someone with their hand up because we're pushing through. So what we're doing for the rest of today is just giving you a bit of an overview of what the course is going to cover. So this is a course about portfolio management, delegated portfolio management for the most part. In other words, you're not managing your own money, you're managing someone else's. So how we define portfolio management is managing invested funds towards objectives. And as you're going to see through the course, those last two words of that definition are absolutely critical. It's not just about, I know how to invest money, I know what stocks I like, that's what I'm going to buy. It's about understanding your investor before anything else and tailoring the portfolio to suit that investor. Now, if you're investing for an individual client, then that would be all about talking to your clients, getting them to fill out questionnaires, understanding what they are specifically looking for, and keeping track of any changes, right? Maybe their preferences or their risk appetite changes. Maybe their job changes. Their age will certainly change. Understanding how that will mean that your portfolio has to change with them. If you're managing a pooled fund, like a mutual fund, then typically what will happen is you will structure the fund around a particular mandate, and the investors will pick that fund because it suits them, right? Whether that is a value or a growth-focused fund or a life cycle fund, whether you're it's a tax minimization fund, whatever it is, you then need to focus on managing your portfolio to suit the objectives of the fund, because in doing so, that will suit your investors' objectives because they picked the fund for those reasons, right? So it's all about understanding your key objectives for the portfolio. So obvious ones, maximising return, minimising risk, right? That's drilled into all of us from day one. And we know that there's a trade-off involved, right? The highest returning stocks are not necessarily the lowest risk stocks. In fact, they almost never are. But we know that diversification will help us to reduce our risk per unit of return. So they're two obvious ones. But in this course, we're going to bring in a lot of others that modern portfolio theory ignores. Liquidity is a big one, right? So, for example, do I need my money in a hurry? If I do, I need my investments to be fairly liquid. Now, this might be as simple as the day-to-day operation of the market that you're talking about. So an example from my life at the moment is that I'm in the process, the long process, of trying to find an investment property that I'm going to rent out, right? Which means that I'm getting used to going to a lot of auctions. And I might think, well, I've got enough money for a deposit, so I don't need to worry about, what form that takes. I'm just going to go and bid. But if all my money is tied up in my CommSec account, invested in shares, and the auction is on the Saturday, and I need to make an immediate settlement because I'm successful at the auction, I can't say, look, sorry guys, I have this great CommSec account, and on Monday I will totally go and liquidate a bunch of shares. They want the deposit on the Saturday. Right, so I need to make sure that my money is in the right vehicles that mean I can immediately satisfy the outflow. If you think bigger picture, think about an overall superannuation fund. And imagine that you are really close to retirement and you want to, at retirement, take a lump sum and have to liquidate a large proportion at least of that fund. Now let's say that you have a lot of that money invested in a private equity fund. There is a secondary market in private equity, but it is very illiquid. So when you give your money to a private equity manager, you are giving it to them for about a 10-year horizon. And if you're only in year 3, you can't go to the private equity manager and say, give me my money back, because they've picked those companies with the 10-year view. They might be trying to exit the strategy 8 years in when they take it to IPO. They're not going to say, look, sorry, you wonderful little startup firm, some of my investors want their money back, so forget about your idea, I'm taking it back. It doesn't work that way. So you go, all right, well, I'll sell it in the secondary market. But because it's illiquid, you're going to take a massive haircut. Can someone tell me what a haircut is? Transaction cost. It means that when you sell, you're going to have to sell it at a discount to net asset value. Okay, so you really need to think, do I need the money in a hurry? And if I do, are my investments in vehicles that will enable me to get that money? And on top of that, all right, shares. If I need my money on a Wednesday in a hurry, fine. If it's public, I can sell it on the exchange. But if it's a liquid, then there might be price impact and I might need to sell it at less than I wanted to. Okay, so on the other hand, if you're in super and you're not going to retire for 40 years, illiquidity isn't a problem for you right now because you won't withdraw the funds. Steady income stream. So perhaps you are retired or you're in a job. You might be a writer that is relying on sales from a book that you haven't written yet. So you might want a steady income stream from your investments, and that's going to enable you to live week to week. Or you might not actually need a steady income stream through dividends or coupons because you might be, ages away from retirement. You're talking about your retirement fund, and you might be happy to just get capital gains. It might be that your focus is on minimising tax. Now, if that's the case, capital gains over dividends can have a big impact here. Because in Australia, if you've held an investment for at least a year, you can be eligible for a 50% capital gains tax concession. Okay, and we'll look at that later on as well. So it's all about figuring out, of this list and others, what the big objectives are for you and focusing on them. You're not going to hit all of them at once. Okay, if you ever get a manager come to you and say, I will invest your money in a way that will give you maximum return for no risk by only investing in liquid assets that give you a steady income stream with massive capital gains and you're going to pay no tax, you just run in the other direction because I promise you it's not true. Okay, it's all about what is most important and focusing on that. And then the others, if you can bring it in, great. But if you're going to have a fund that is focusing on liquidity, it'd be great to get a bit of uplift through private equity, but only if you've got a mandate that enables you to have a small proportion of your fund in illiquid assets. So who is identifying the key objectives and who is managing these funds? The portfolio managers. And they are delegated the authority, responsibility and accountability for investment performance. Where the actual portfolio manager function can reside can get a bit more complicated because actually it's not one role, right? It's a lot of different roles. If you forget about the industry for a second, if anyone here has a ComSec account or trades on their own app through whatever vehicle it will be, then when it comes to your personal trades, you are a portfolio manager, right? Because you are actually investing on behalf of yourself. In fact, you're both the portfolio manager and the end investor. And the good thing about that is that you are very good at understanding what your end investor wants because the end investor is you, right? But you are still performing a PM role and you have the authority, responsibility and accountability for investment performance. Now let's stick with our individual lives outside of the industry and think about an example that might not be immediately as obvious. Remember, I said in Australia we have member investment choice. Let's say we pick a superannuation fund that enables us to choose what we want that strategy I told you about to be, right? Do I want high growth? Do I want conservative? By making that decision, we are partly responsible for how our portfolio performs because we're making that initial first step in deciding strategy that will feed into asset class mix, that will feed into the investments that occur. So we do have the authority, responsibility and accountability for part of that investment performance. Because if our conservative fund, and I chose that policy, if it didn't do well and high growth did really well, that's not the fault of the portfolio manager. I've only got myself to blame because I was the one that said I wanted conservative when maybe that wasn't right for me and I didn't think it through properly. In the industry, where the role is formalised, again, it can sit at a number of different levels, right? You might be doing what we're going to do in the first 5 weeks and be sitting with the asset allocation decision, right? So you have a big fund, it has a lot of buckets, and you say, how much do I put in equities? How much in fixed income? How much in property? How much in infrastructure? Or you might be sitting within the bucket and you might say, okay, well, within my equity bucket, what stocks am I going to purchase? Within fixed income, what bonds am I going to purchase? All of these are portfolio manager roles. So if you're asked to define it, you just need to ask, do they have authority, responsibility and accountability? Because that's the common factor. So before we get into this too much, it's often good to see a diagram where you can see how this all hangs together. Now, Jeff Warren, who's another academic here, he created this course and he has a wonderful name for this diagram. I really love it. He calls it the Great Ticket Clip. And the reason is that this is an industry that makes a lot of money from managing other people's money. Every arrow you can see there, and you can see it's double-sided, money is flowing through those arrows. Every time money flows down the arrows, someone is going to take a clip out of the ticket that is the fund. So you might be an end investor that put your money with an aggregator. The aggregator takes a percentage of assets under management. They may then put some of that money, say the international equity portion, through an investment manager like a mutual fund. Particularly if they're active, but even if they're passive, they're going to take a little chunk as well. They might then invest in assets through investment banks, who take another cut. And as you can see, what happens, more and more money gets peeled off this ticket, so that what you end up with is an industry that has a lot of little bits coming off it. I will clean this up, I promise. Has a lot of bits coming off it. They've made a lot of money from managing other people's money, and the bite available to the end investor is shrinking. So there is a bit of contention that's also been the focus of things like the future of financial advice reform over whether essentially things like commissions and percentages are too high, and whether people as a result are really able to act in the best interest of investors or whether conflicts of interest exist. And I'll talk about that a bit more when it comes to financial planners later on. Okay, so at the top in blue, we've got the end investors, the beneficiaries. These are the people that have the money, invest it ultimately into the assets and get the money back, hopefully with a good positive return. If we go to the right-hand side here, where you've got the long arrows, this is what we call the retail side. One example of this is the end investors investing directly in assets and then getting the money back. So this would be if you are trading on your ComSec account, for example. One in, you've got the end investors investing in assets through investment managers. So, for example, a mutual fund that then invests in the end assets and returns the money back to the end investor. You've now got a middle section in there that's taking a clip out. You're paying your fund manager fees, but you're getting the return still on the retail side. On the left-hand side, in the brown box, you've got the wholesalers, and we call these the aggregators, right? Because wholesalers are collecting, aggregating money from a huge number of end investors, pooling it together, and then managing that money on behalf of the overall investment pool. So we've got a lot of different types. The first is super. I'll come back to that in a moment. That's the big focus of this course. But you've also got insurance companies. So, right, insurance companies are going to collect the premiums from the investors. They're going to invest those premiums, and then the premium plus the return on the investment is hopefully more than enough to satisfy any insurance claims that are made. Any amount in terms of the premium plus return that is more than the insurance claims gets to go to the insurance company as profit. They're what we call a liability-driven investor, and we'll look at that a bit more next week and in week 5. You've got endowments and foundations. So endowments are things like your big university endowments. Much bigger deal in the US. Harvard and Yale are massive. In Australia, it is there, but it's less of a focus. We've got a decent endowment fund at the ANU. It would be lovely if all of our alumni decided to give more back in Australia, like they do in the US, but as it is, you know, it's a pool of money that you collect, often from donations by alumni, and you invest it to earn a return, and the investment plus the return is used to further the university. It might be to fund a big new science lab, or to bring a big professor in, or to start a new think tank, initiative, whatever it may be. Charitable foundations. Obviously, the focus will depend on the charity, but again, they collect the donations, invest it in assets. Donation plus return will fund whatever charitable cause it is. Does anyone know what's the largest private charity in the world? Bill and Melinda Gates Foundation, right? They've got a number of different initiatives, poverty, healthcare. They're getting their donations, investing through financial markets, and it's going back to sponsor their charitable causes. By the way, if I can encourage you to do anything in this course and others, it's to actively connect with the concepts that we're doing. So I've used this one as a bit of an example. I've actually got a link here, but actually instead of doing that, what I'd love to see people doing as they go through the lecture notes, before the lecture, after, whatever, is they go, okay, well, we've learnt about charities. All right, so what is the largest private charity in the world? Because and you can see Bill and Melinda Gates Foundation straight up there. And then you've got, so you've got the Netherlands, you've got the Wellcome Trust is the UK, also focused on science, by the way. But you can see that as you're learning about these investors, you're seeing examples of investor types. I'll provide you with them as you go. But if you start to Google this type of thing, you start to connect concepts with the real world. And when you do that, you remember it, you understand it that much better. Sovereign wealth funds is a pool of money collected through taxes or whatever other initiative that is used to fund shortfalls for a government, to spend on government initiatives of whatever type it may be. So what sovereign wealth funds, the outflow for sovereign wealth funds will be very specific to the country. But the principle, again, is the same. They collect the money, invest in assets, get the return back. Does anyone know what the largest sovereign wealth fund is in the world, or the country? Norway. It comes from oil money. Funnily enough, they've changed the name of that sovereign wealth fund, so it's a little bit less clear from the name that it's focused on oil, but the origin of that fund is very much from oil money. Australia has one. What's it called? It's called the Future Fund. Other big ones, Singapore has two, Government of Singapore Investment Corporation and Temasek. And again, if you have a look here, you want examples, I've just put the link in here, but you can get it through Google, and you'll see the latest Sovereign Wealth Fund Institute rankings. And it can sometimes be really interesting to actually go and research what these guys are doing and have a look at the investments that they're doing. Sometimes they'll talk about their asset allocation. They'll talk about the initiatives that they're spending money from. So you can see Norway is now the government pension fund global. It doesn't have oil in its name anymore. CIC obviously is another big one from China. Okay, so if we go back to superannuation, which is a big, or pension funds, which is a big focus in this course, the big split in superannuation is between defined contribution and defined benefit. Defined contribution, can anyone give me an example or tell me why do we say it's the contribution amount that's defined? What happens with a defined contribution? Yeah, that's right. The employee doesn't bear the risk. So in a defined contribution, the contribution amount is defined, right? In Australia, you've got a minimum employee super contribution of what percent? 9.5. Yeah. So the employer contributes money over your working life. You can add to that. This is assuming you're not working for yourself, by the way. And that is invested to grow, and whatever it grows to is what you guys have to retire on. The employer does not bear the risk of that. The employee, the retiree, is the one that bears the risk of investment performance. If markets are low when you retire, you have less to retire on. If markets are up, you get that uplift. Defined benefit is different. In defined benefit, it is the benefit that is defined. So what would that benefit be? It's the amount you get to retire on. It might be a lump sum, it might be a pension stream, it might be a mix. But essentially what happens is the sponsoring entity, so your employer, for example, or whoever's running your defined benefit fund, they will carefully manage their money with the goal of ensuring that the money grows to be enough to fund what they've promised you that you will have to retire on. You don't know in advance what the dollar amount will be. It's based on a formula based on the number of years that you've worked there, your ending salary, and a lot of other things. But in defined benefit, it is the sponsoring entity or the employer that has the risk of investment performance. Because if the defined benefit fund is insufficient to satisfy the obligations promised to the retirees, then the sponsoring entity needs to make up the difference, right? No matter what, when I retire, I should get my promised amount. If the company doesn't have enough, they need to come up with a shortfall. If there's more than what they need, they get to keep the benefit as profit. More and more, we are seeing a big shift away from defined benefit towards defined contribution. That was really enhanced in the GFC because a lot of companies that were defined benefit ended up with massive shortfalls, and it actually put a lot of them in really big trouble. They just don't want to bear the risk of investment performance anymore. So, for example, the US used to have a large proportion of defined benefit. It's moving more and more to defined contribution. And if you guys have ever heard of the 401k, that is a defined contribution plan there. Australia has always had a big history of defined contribution, and that is just continuing to develop. We see more and more DC assets invested. All right, now if I just split up what super funds can be to give you a couple of examples, you can have a retail superannuation fund, right? So that is pulling together money of individual retail investors, investing into end assets to come up and fund them in retirement. So that's things like A&P and Russell. And just quickly, a retail superannuation fund is still a wholesaler. It is not on the retail side. It's called retail because it is pulling together the retail investors' money. I'll talk about that again when we go through a practice exam before the mid-sem, because that was a multiple choice question a while back. I won't give it to you because it's in the practice exam, but I just wanted to call your attention to that now, and we'll talk about it again later on. Corporate superannuation funds is when your actual company is running the superannuation fund. So Telstra has one, BHP has one. They're becoming increasingly unpopular, right? Corporate super funds are a sort of a dying breed. There's less and less of them around. They're easily the smallest slice of the super industry now. Industry is where you've got a superannuation fund that manages a super of a particular industry. So as an academic, we have UniSuper. Hospitality industry has HosPlus. If you guys have heard of AusSuper, that used to, essentially what AusSuper is a multi-industry super fund, because there were all these separate ones that just kept combining and combining and combining. So AusSuper is now a super fund, but, an industry fund, but with lots of different industries within it. Public sector will manage the super for public sector departments. So for example, Q Super is the superannuation for Queensland Super. Now, the other thing that we haven't spoken about yet is those grey boxes, financial planners and investment banks. They're grey and dotted because you don't need to use them. You may or may not choose to go through them. If we start with financial planners, so for example, if I'm an end investor and I want to invest in an investment manager that will go and invest in the end assets, I may be unsure which investment manager to put my money with, so I may go to a financial planner and ask for them to advise me. Now, this is a really interesting area because it's one of the places in Australia where the government has stopped that ticket clip. Because what used to happen is a financial planner would provide advice, and for every one of my dollars that went into the fund they recommended, they got a cut. What's the problem with that? Conflict of interest, exactly, because let's face it, if I'm a financial planner that wants to maximize my profits and I'm a little bit dodgy, the incentive is to recommend the funds that give me the biggest cut of the money I direct to them. And that actually was happening, right? We actually had some pretty high-profile collapses. So I don't know if you guys have heard of West Point. That was a real estate company. Storm Financial. Trio was a massive superannuation fraud that Australians lost about $200 million of super because of Trio Capital. But if you look at Storm and West Point, they were big, high-profile blow-ups because essentially they were directing clients' money into inappropriate investments. So the government started the Future of Financial Advice reforms that essentially put a limit on commission-based recommendations and made it a much more simple fee-for-service setup. You know, I provide you a recommendation, you pay me a fee, but I don't get a cut from the funds that the money goes into. And investment banks are things like, your Goldman Sachs, your Morgan Stanley. It might be that you want to buy or sell assets by going through the investment banks, or it might be that they actually generate the assets. So they will actually go through a process of an IPO and offer the shares to their clients. So to talk about some of the players in the industry, if we sit at the overall plan level, so the broad super fund, at the top is a board of trustees who have a fiduciary duty to act in the best interest of the end investor. And that's the focus of one of your examinable readings this week. Underneath them sit the investment management staff, led by the CIO, the Chief Investment Officer, and they oversee the day-to-day running of the fund. So they pick the managers, they pick the investments, for example, they deal with the clients. So the Board of Trustees don't necessarily need a lot of specific investment knowledge, and you'll see that in your readings, because that investment knowledge, that sits with the investment management staff for the most part. You might have asset consultants who use them as you need to provide advice. So that's your Mercer, your Towers Watson. You might ask them to come in and advise on helping you pick an appropriate fund manager if you feel like you don't have the expertise in that area. Wherever you feel like you're lacking, you might hire an asset consultant to come and help you. Now, implemented consulting is like asset consulting, but you don't just advise, you do it. So, for example, if you're a big fund, you might have an investment management staff of 50 to 100 people that are doing all of the investment themselves. If you're a small fund, the investment management staff might consist of a fund secretary, and everything else might be done through an implemented consultant, right? They don't just recommend the fund managers, they help you put your money with them, or they help select the investments. And the sponsoring entity is unique to super funds, and they're essentially the ones that, if in the case of a defined benefit fund, bear the risk of investment performance. Right, in a defined contribution fund, the sponsoring entity just is the one that is administering the fund. It doesn't really matter. They don't have the risk of investment performance. The retiree does. But in a defined benefit fund, the sponsoring entity is the one that if the fund isn't big enough to satisfy the benefit that has to be paid out. The sponsoring entity needs to come up with the rest. If we go down to the investment manager level, your traditional investment managers are things like your mutual funds. It might be equity, it might be fixed income. We'll look at a lot of examples. It might be a hedge fund manager. If it's private equity, you'll do it through a partnership, so a general partner, and then they have limited partners that they pull the money from. LLC is a limited liability company that's like a fund set up within a company structure, so it's listed. Fund of funds is when you have a fund, but they don't invest in assets. What do they invest in? Funds, right? So you have, say, a private equity fund of fund, and they're quite popular in private equity. The private equity fund of fund gathers money from listed partners and splits that money into different actual private equity funds, and those private equity funds go and invest in the private equity firms' investments themselves. The great thing about that is with one investment in a fund of funds, you have good diversification. What's the downside of a fund of fund? Fees, right? You're paying both the fund of fund manager and the fund manager's fees. So we'll look at that more later in the course. ETFs is when you've got a fund that's actually listed on the exchange like a share, which is really nice because if I want a passive exposure in world equities, I can just go onto the ASX and buy BlackRock iShares, and suddenly I've got exposure to an overseas equity market in a diversified way. So it's a very easy way to get a broad exposure. They're also really common in assets where it's actually really annoying to have to store the assets. So gold ETFs are really big because let's face it, if you invest in gold, all right, lucky for you it doesn't erode or tarnish or fade, but they're quite heavy and you need to put them somewhere. Or you could just invest in a gold ETF, and it's the responsibility of the ETF, the fund manager, to figure out one big warehouse to store all the gold, rather than every individual having to store their own. There's a difference between pooled funds and separately managed accounts. In a pooled fund, essentially, you've got a lot of different investors, you're pooling all of their money together and investing that whole pool on behalf of the group. In a separately managed account, you are investing to suit one individual. So if you're very wealthy, you might say, you know what, I don't want to put my money with everyone else's. I want you to manage the money for me, for my specific objectives and constraints. I say very wealthy because if you don't have enough money behind you, it won't be worth the fund manager's while. But if you are wealthy enough, there are advantages to this, right? Like, let's say that you are a really strong ESG investor, or SRI. What is SRI? What does it stand for? Socially responsible investing. What about ESG? What's the E? Environmental. What's the S? Social. G? Governance, right? So in either case, you might find that the pooled investment manager isn't going to avoid the huge list of stocks that you want to avoid, right? No gambling, no tobacco, no alcohol, no testing products on animals, because they need to do what's best for the group. So you might want to go to someone and say, I want you to invest just for me, and therefore I can say, avoid all of this list of industries and stocks. Roles, CEO, what's that? Chief Executive Officer, they are responsible for managing the business. CIO is a chief, what's the I? Investment Officer. Often it's information, but in this world it's investment. And they're responsible for overseeing the investment process, hiring and firing the managers, for example. The portfolio managers, we've already said, they're the ones that actually deal with the investment in the assets themselves. They might have analysts working underneath them to provide stock reports and feed up recommendations to the portfolio manager. Client relationship managers are the ones that go out and market the fund. It's a sales role. Risk officers identify, assess and monitor the risks of the fund and check that the fund is always complying with the mandates. Should risk officers and PMs be the same people? Portfolio managers? No, right? Because if I'm a portfolio manager, I want to do what I want and say, yeah, I comply with the risk, it's fine, it's all good, don't worry about it. You need someone that's independent that says, hang on, I'm looking at what you're doing and it doesn't look right. You've breached a risk covenant. For the same reason, the people that measure performance should not be the portfolio managers, because the portfolio managers will say, yeah, I'll measure the performance. Look at that, I'm doing really well again, right? You need someone independent that says, I am going to use independent methods to assess the performance to avoid the conflict of interest. And back office functions are things like settlements. So this is a tough industry to get into, and often what you get is people breaking into the industry through either a back office or perhaps performance measurement function with the view of moving into an analyst role later on. Distribution, wholesale versus retail. So retail is marketing your fund to end investors, the retail clients. Wholesale is when you actually invest through an aggregator. So that was the two different sides of the diagram. The two different sides of the diagram. Direct is when you go straight to the end investor, or you might actually get money via financial planners, brokers, or platforms. So direct would be the end, it would be this end arrow on the right-hand side without the grey boxes, or you could go via the financial planner, or you could go via a platform, which isn't sitting in the diagram there. Platforms are really cool. I've got two examples here, Macquarie and BT Wrap, just for your interest. They're not at all a recommendation of any kind. What platforms do is it's like a supermarket, but for funds, right? They have a whole lot of funds listed on that platform. So you can pay money to access the platform and see a bunch of different options. Pick a few different funds from that platform, and the platform will give you consolidated financial statements and tax advice. And because being on a platform really enhances the visibility of those funds, the platform can actually typically negotiate things like fee discounts, right? Just like Coles and Woolies can. They'll say, all right, if you want to be on my platform so that a lot of the investors that are part of the platform can see these funds, we'll do it, but you need to give us a bit of a discount that they can then pass on to the clients of the platform. So they're quite nice things to have. This is just a bit of a heads up before your tutorial, because the focus of your first tut will partly be on agency problems. You've got agency issues in portfolio management because you're managing money on behalf of other people, not yourself. And you're never going to be as careful with other people's money as you would your own, or at least we'd like to think you will be, but you might not be. So that means that there can be conflicts between what the end investor wants and what the management or the management company wants. There's one thing that we all want, and that is profits. But not everyone will get those profits in the same way. So here's some classic examples. Let's think about the optimal size of a fund, so the optimal assets under management that you're going to invest in. The fund management company gets their profits traditionally by a percentage of assets under management. So if you want to increase your profit as a company, you can either increase the percentage that you charge or increase the assets under management. This is a very competitive area, so it's very hard to increase the percentage you charge very far. You increase it too far, you're going to lose all of your customers. So they like to encourage more and more assets under management to boost their profits. That's not necessarily good for the end investor, because as more and more money goes into the fund, they're trying to channel more and more money into mispricing. We're talking about an active fund here, right? So let's say I found an underpriced stock. When I'm small, I might want to spend $25,000 exploiting that mispricing. I can purchase the stock, wait for the mispricing to correct, sell it at a profit. When I now have $250 million to put into that opportunity, what's the problem? I'm going to find an underpriced stock, buy $250 million worth of it, and what am I going to do? What's going to happen to the price? It's going to go up, right? The bigger you are, the bigger the price impact of your trades. So that means that profit opportunities that were available when I'm small are not going to necessarily be available when I'm a very large fund. So the end investor that just wants a high return, they will have an incentive to want you to stay small. The fund management company that isn't getting performance fees, they're getting management fees, so that only depends on how big the fund is, they want to be big. So you've got a conflict. The fund manager in the middle wants to do right by their employer, the fund management company, But at the same time, they want to actually maximise their reputation and their track record, so they have an incentive to also want the fund to stay quite small so that they can actually get those alpha opportunities without shifting the price by being too large and having the price impact cost. So that's just to get you guys to start thinking. There are many other examples, and you're going to talk about a lot of different areas of conflicts of interest in the tutorial. And to finish up, this just provides you with the roadmap for the weeks ahead, essentially, and it's structured around the asset management decision process. The first thing you need to do is you need to plan. And the only way you're going to do that is by getting a good governance structure in place. Who is actually responsible for what? We're going to actually finish with governance because we want to leave it till we know all the players, but it is the first step in your typical process. Once you have a good governance structure, you then need to figure out your investors' objectives and constraints. Remember, it always starts with the investor. So we're going to look at that next week. Once you know your investor, you decide your asset allocation. So that's weeks 3 to 5.